Right now, your feed is probably full of people saying Japan is 50% off. Cheap hotels, cheap sushi, cheap everything. And yeah, tourists are lining up at Narita Airport duty-free, credit cards out, feeling like geniuses. But here's the thing, that cheap feeling, it's actually one of the scariest signals in global finance right now. The yen just hit 163 to the dollar, the weakest it's been since December 1986, almost 40 years. And this isn't a great time to book a trip to Tokyo story. This is a story about your money, even if you've never set foot in Japan. And if this trend keeps going, this could turn into the biggest currency move any of us have seen in our investing lifetime. So if you've got money in the market at all, even just an index fund, this affects you more than you think. So let's skip the suspense. Here's the one-sentence version of everything happening right now. Money that used to sit inside Japan is packing its bags and running to America. Break that down, and you get 3 questions we're going to answer today. Where is the money leaving and where is it landing? Japanese bonds and yen deposits moving to U.S. treasuries and dollar assets. Who's actually pulling the trigger? Japanese retail investors, hedge funds running the yen carry trade, and the U.S. bond market itself. So where does that leave you? Japanese exporters riding the weak yen and U.S. safe haven assets picking up the overflow. We're going to take these apart one at a time with real numbers. And honestly, it gets more interesting the deeper we go. Why do you actually need to watch this video? Because once you understand why the yen is collapsing and how that ripples into U.S. stocks, bonds, and your portfolio, you stop reacting to headlines and start seeing where the money is going before everyone else does. My name is Moon, and I spend an unhealthy amount of time obsessing over where money actually moves, not where the headlines say it moves. If you've ever looked at a currency headline and thought, okay, but what does that have to do with me? This channel is for you. Hit subscribe, and if this video actually helps you connect the dots, drop a like. It tells me to keep making more of these. Now, here's what most people genuinely don't get. A weak currency does not mean a country's economy is bad. A currency's value is basically a vote on where interest rates pay you more. Let's put real numbers on this. The U.S. federal funds rate is sitting around 4%. Japan raised rates in June, but it's still hovering near zero. Now imagine you're holding $10,000. Park it in a Japanese account. You're earning next to nothing. Convert it to dollars and put it in U.S. treasuries. You're earning meaningfully more, even after conversion costs. So institutional investors, hedge funds, even Japanese pension funds, they're all running the exact same math. Okay, so why doesn't Japan just raise rates hard and fix this? Oh, you're probably thinking that right now. Because Japan's government debt is over 260% of GDP, the highest of any major economy. Raise rates fast, and the interest bill on that debt explodes. So the Bank of Japan can only inch rates up, tiny step by tiny step. That trap is the real backdrop to everything happening with the yen. Here's where it gets genuinely interesting. This whole flow has a name, the yen carry trade. Think of it like this. You rent an apartment for almost nothing, then sublet it out for 5 times the price. As long as that gap exists, the game keeps running. According to CFTC data, leveraged traders are holding roughly 138,000 contracts betting against the yen. That means a massive number of professional traders are all betting the yen keeps falling. And the more that bet piles up, the more it becomes a self-fulfilling spiral. And this isn't just theory. Back in August 2024, a smaller version of this same unwind erased trillions in global market value in about 72 hours. That's the risk hiding underneath all of this. A trade that looks stable for months, sometimes years, and then unwinds in days. Some estimates put the total size of this trade in the trillions of dollars, so even a small unwind can move markets hard. On top of that, Japan's ruling party recently pivoted toward more aggressive government spending instead of fiscal tightening. And the market reads that as, Japan's going to borrow more, which means they can't afford to raise rates hard. So the selling pressure on the yen gets even stronger. So right now, there are 3 hands selling the yen at the same time. Carry trade hedge funds, global capital fleeing to safety, and bond investors worried about the fiscal outlook. Now here's what people really don't get. A weak yen feels like good news, because the first thing we notice is, wow, Japan got cheaper. This is exactly the myth we need to bust. weak currency equals automatically great for exporters is only half true. Short term, yes, companies like Toyota and Sony see their overseas revenue look bigger once converted back into yen, so their stock prices tend to rise. But at the same time, Japanese retail and consumer stocks have been getting sold off because import prices are rising and real household income is shrinking. Here's the psychological trap. People assume our currency is cheap equals our stuff sells more equals we win. But if you actually earn and spend inside that currency, you're the one losing real purchasing power. Japan's real effective exchange rate has already fallen to its lowest level since the floating rate system began in 1973, down to roughly a third of its 1990s peak. In plain terms, Japan's headline GDP might hold up, but on a real purchasing power basis, the country has been quietly getting poorer. Okay, so here's where it gets useful for you specifically, as someone investing in the US. First, watch the Fed's rate stance. More than half of this yen weakness comes from the expectation that US rates stay elevated. If the Fed signals rate cuts, that gap narrows fast, and the yen could snap back hard and suddenly. Second, watch for Bank of Japan intervention. Japanese officials have already used the phrase decisive action if needed. If that intervention actually happens, the yen could jump several percent in a single day, and anyone short the yen through the carry trade could get wiped out fast. That's called a carry trade unwind, and it's genuinely one of the fastest ways to lose money in this market. Third, so where does that leave your portfolio? Broadly, 3 lanes to think about. Lane 1, large Japanese exporters, autos and electronics, benefiting from the weak yen through an ETF. Just check whether it's currency hedged because an unhedged fund can see gains wiped out by the exchange rate. Lane 2, U.S. short-term treasuries and money markets, the exact assets carry trade capital has been flowing into. Lane 3, if you want to hedge against a sudden BOJ intervention or Fed pivot, consider allocating a small slice to yen-denominated or yen-hedged positions. Now, a lot of people are going to stop right here and go, yen is cheap, book the flight, and move on. But the real money in sight is the part right after that. But isn't this already priced in? Isn't this old news by now? You might be thinking that. Here's the honest answer. The direction is known, but the timing of the reversal isn't. That's exactly why the triggers matter more than the current price. Exchange rates are the earliest signal board for where cross-border capital is actually moving. Right now, it's telling you U.S. assets still hold the relative advantage, and it's also warning you that the trigger to flip this could fire any day. Let's bring it together. The yen just hit a 40-year low, and that is not a great time to visit Tokyo Story. It's a massive capital migration out of Japan and into the U.S., driven by rate gaps, fiscal worries, and a global flight to safety. And the people who understand why it's moving get to move before everyone else does. But remember, this flow isn't permanent. A BOJ intervention or a Fed pivot could flip it overnight. So don't just watch the number. Watch why it's moving, and you'll actually be ready for what comes next. Most people watching this will forget about it in a week and get caught off guard when the reversal actually hits. You don't have to be one of them. Bookmark this, come back when the headlines change, and you'll already know what's happening. If this helped you see the market a little differently, hit like, and let's keep tracking where the money moves together. Subscribe and turn on notifications so you don't miss the next one. Protect and grow what you've built. I'll see you in the next one.